Good people, how are you? I'm here to talk to you about the precious metals market. Key point. Most people are not understanding the secular, the macro, super macro cycle scale of the move that is going to come in precious metals, which in my opinion, on balance of probabilities, is going to surpass the 80s and the 2007-2011 run by a big multiple. I'm here to make the case for why I'm the biggest bull, a bigger bull than Peter Schiff. I'm here to tell you the things he hasn't yet been able to tell you that will make it go even further, and why silver is even further on that, the biggest of the lot. And I'm also here to remind you of a major key aspect risk that such a move will force, and it involves government and state. Let's start with the debate had on Twitter. So looking forward to having Brent Johnson on an interview on our podcast. Watch that here. We'll also have had Lynn Alden agree. We're looking for other high quality guests to do a bit more interactive rather than Mr. Sniper himself monologues. And we're going to get other people's opinions, ask the best questions we can, and really open up the bowel and read the entrails for what lies ahead for us in this great world. So looking forward to Brent. Always useful when someone holds a view that is diametrically not supporting your view, because it forces you to dig deeper and to stress test, and it forces you to reassess. Remember, in the world of science, peer group review is to seek to disprove. They do not have an emotional reaction. I respect these people, and it's very useful, and I'm glad to have them. And it's a very good process. So let's just have a look at this tweet over here. So I'm going to just broaden this out. I've got the screen specially to be fancy tricks with you. It's very amazing. We do all our internal streams to the Sniper community with this huge Wacom. It's awesome. So that's what Brent put out. It's from his Bloomberg screen, I'm assuming. That's the image. Is this one going to last, or will it be like the last five? This is his question. Reach for the pen, reach for the pen. We got a transgender pink on that one. So here we go. So there's one event over there. Got to get into draw mode. There's one event over here. 2, 3, 4, 5, and 6. These are circled highs that he's brought to bear. In actual fact, I should do this a little bit bigger. We can come back for my response. Let's hit the image. And we can make it a bit smaller, but generally a bit larger for you. So there's the Bloomberg screen annotation. Why are you doing that? Okay. Doesn't want to play now. Too clever by half with all my bragging. There you go. I'll just do that and leave it in its draw mode. So what is highlighted is the 80s, clearly, which was the bull, a pretty serious bull run. That, number 3 in green, number 4 and 5. And he's saying, is 6 going to do much more? Is 6 going to do much more? Is this just a spike? It looks like a stochastic that grinds along the bottom indicator that occasionally has a spike. So first of all, I want to highlight that the momentum, the rate of ascent, and the scale of the move already experienced in the move up to 29. Yes, we have had a small pullback already. That is not captured in that screenshot. Already surpasses this little effort by scale. So I'm saying it's already shown that it's bigger and more significant than that. It's already shown it's bigger and more significant than that. And it's already shown it's got far more momentum. This was a rally in a bear market after a super bull. So this is just really a bounce. So I'm taking, of the 5 he's claiming, for which the current move is the 6th, I'm taking 3 out of the discussion entirely. They've already been surpassed. They've been surpassed in both momentum and scale in dollars. So we're left with the original 80s bull market and the 2007-11 run in bull, in precious metals. And he's, of course, looking at silver right now, which is the higher beta and was pulled lower by the events that occurred in the 9-year bear market since 2011. Gold has held up better and has already passed and made new highs. So let's just get into this argument. And this is my technical response. And the best response is actually to look at the valuations of silver to gold. The question that he's raised is silver. The question he's raised is silver. And so we open this chart that I've done, and I'm going to have the same problems there. So I'll just expand the screen. If you're not following the Market Sniper, please do on Twitter. This I actually prepared for the premium community, and because this is such an interesting topic, I'm releasing it later on now, free view to everybody to consider and contemplate. So we really love charting, and there should be some good quality charts out there. So this is the gold silver ratio, XAU, XAG. Now it's inverse correlation. So that means a super low value means you only need 16.5 at this extreme low that I've highlighted in the blue. We'll stay with our transgender pink. We only need, whoops, we've got to get into draw mode, haven't we? A little bit of fumbling around today. Excuse me for that. There you go. 16.5 was a very low gold silver ratio for the period under review. And it meant 16.5 ounces of silver buys you 1 ounce of gold. That was the 80s high in gold, but even more so in silver, which also involved the bunker hunt 70s, late 70s into 80s run, when they felt that, not family by the way, when they felt silver was undervalued and they started accumulating, and the derivative boys went out to bust them. Anyway. So actually they're more heroes than villains. They're cast in mainstream media as someone trying to corner the market. There's nothing wrong with buying silver if you think it's undervalued, by the way. Anyway, so this is actually a bear market channel that you see rising up that saw the lows in silver valuation requiring 102. I actually don't like this on Twitter. It's gone all fuzzy when I expand it. I'm going to get out of here and do it rather on my Snagit. So let's go here. That's a lot sharper. There we go. That's it. So I'll scribble on here. It's a lot sharper. Image within image. The pixelation goes down. So this was the bull market highs in precious metals for both silver and gold. And the relative valuation, because silver's a higher beta, was very low. Only 16.5 ounces required to get a single ounce of gold. At the bear market lows that then, and it wasn't the absolute lows, but it was in silver and gold valuation lows of the 90s. This was the beginning of the dot-com boom running all the way through the 90s, irrational exuberance, etc., etc. We went as far as 102.1. Now, how did I get so much history? There could be more. I'd love to have more. I love data, and I'm interested in data. I took the gold futures, I took the silver futures, and I've divided them out. That's the formula if you want to repeat that chart. And this is a monthly chart so that we can go right back to 76, way back then. Right? So everyone follows and understands what we're looking at. So I've created the ratio. I didn't take the charts of the ratio that someone else is. I've done the maths. So on our normal ratios, if you're using Saxo or Oanda, we actually have 128 as a number here. This one I got 126.6 as the high. Anyway, so let's finish with this. This essentially was a channel bear market in the precious metals, which obviously saw the loss of value in silver relative to gold till it took 102 ounces. Now, from that same Twitter discussion, there was a couple of questions from some followers that regularly follow. And this is also here. So this gentleman is asking, that's very impressive charting. Thank you. It took 20 years to get from 102 to 30 is the question he's asking. So he's asking with regards to this descent here down to here. Now, here's why it took so long, and normally I don't expect bull markets to represent like that. In fact, most people only realized the bull market phase coming during this here. That capitulation in value, and it was what we say in these annotation, essentially that bull market where actually you were as low as in the mid 200s and you ran up to 1,900. I'm saying to you, as bizarre as this will sound, that was a truncated, moderately sized bull market. It was not a full-fledged, allowed to run bull market. It was not a bull market that saw the 80s lows here from in 80s at all. Nothing of the scale. Unfortunately, we don't have the history of the ratio prior to that coming down, nor its speed in doing so. But I will show you what I've done in the data sense. This is actually quite a moderated collapse. And one of the reasons for that is the following. People were continually distracted by fast-moving money. Fast money was first the dot-com boom. So actually gold and silver started to firm up from the Brown's bottom lows when he sold out in the mid 99 or 2000s. He actually sold out in the 2000s. You'd already come off the highs. He sold out round about here. Let's get into draw mode again. He sold off round about there, and that was pretty disastrous. Might even have been a bit later. It could have been over here. I stand corrected. It's not particularly important. But what happened is you had the dot-com tech bubble where everyone was suddenly a day trader. Remember that? And to hire people, you had to allow them to have their pets coming to work and all of this nonsense. There weren't enough labor, blah, 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 blah. It was all the best times, all the best money. There was mass affluence. Everybody's property prices came up. But first you had the dot-com bubble, which was cheap money. And this started to bring down the ratio and get gold a little bit back into the frame. Then, after the dot-com bust that came here, there was deflation, and the gold-silver ratio had this channel, even had a little wind-up HVF, and went higher there. Again, bad for precious metals, particularly bad for silver. Then they kept printing money, and this was the property inflation segment up to here. So there's your property bubble, and here was your tech bubble. So they kept reinflating other asset classes that became the big game. And gold and silver was always the bridesmaid. So tech, all about tech. Did you buy eBay? Did you buy, Excite? Did you buy all during this period? And then have you got buy-to-let properties? How many are you flipping houses for apartments in Miami, yada, Arizona, etc., Nevada? And then the 2007 and 8 crisis, which suddenly saw quantitative easing. This was the introduction of quantitative easing to the Western world. Only Japan until then had done that. Right here. And that was your spiller. But it was truncated. I've earmarked the 30 and the 90, and the midpoint is the 60 for the gold-silver ratios for the modern era. You actually will hear from a Majestic CEO say he pulls out 8 silver ounces for every ounce of gold he pulls. Silver is the most undervalued. He's obviously invested in a lot of silver assets, so he's scratching around in the dirt where he thinks the silver will be found. So that doesn't mean it implies an 8-to-1 ratio, but that's an interesting comment. And essentially the modern era has seen, I would say 30 to 90. Super bulls, full cycles, trade below the 30 level, and then usually have a backlash, bear market, that will take you above the 90 level. This is what I'm highlighting to you. Bear market, the blue box, bull market at 16.5. You never fully crossed the whole range, and you moved quite slowly with these different asset bubbles that were created for you, continually pushing back. So this is not a real whiplash, vicious bull market until that point there, 2011 when the printer started to run. And everyone was in pain, and everyone said it's time to print. In fact, the first QE may have even come during this down leg. I'm not being historically accurate. I haven't checked my facts on that. But it is of the era post 09 and the great collapse and the lows of all the stock markets in March 09, etc. So that was the reinflation and the spoiling of currency, the proliferation of bad money and bailing out of banks, and that's what you got in that short. So this was the key period of it. And wasn't that, when you're looking at a monthly chart, it's actually, this was just a coming off with lots of rallies, pushbacks, drifting down. It's only at that point that other people started to wake up, hey, there's this gold thing going down into 2011 from the 2008-9 lows. And then it was stomped on, and since then we've had a pretty brisk devaluation. Now, the momentum of the bear market was strong. There's your low at 30.5 of around 2011 high, end of 2011. You hit COVID-19, you hit it. This was a 20-year. This was the question that the Twitter. So I'm tying all the threads up here. 20 years bear market. In the silver gold ratio. This wasn't the ultimate low in gold and silver. It actually got at its ultimate low in 2000 over here. But the gold silver ratio was not at its extreme. So it's the ultimate low prices when gold was trading $268 roughly. And silver could be had for $4 or $8, I can't remember what it was. Multiply out at 80 and you'll find out. That was the ultimate lows in value, but already the gold silver ratio was drifting off. So what then we have, this is a lot quicker. This is a 10-year. In the same way, the low here was 80 and you got to around 90. That was 10 years to the bull. Now, this was a 10-year bear market in metals. And this was 20 years in coming for the bull, but actually it was only really there that anything much took place. It was just a drift. Look how different it is this time. And you've always got to be careful of people who say it's different this time. And I'm saying it is different this time because it's showing me it's different this time. First of all, this devaluation was very, very tight. It was in a macro rising wedge. We've done umpteen YouTubes on this. You blew out the top and you had an absolute parabolic melt up in one of the most bizarre, globally affecting, economically destroying events that saw 36% loss in value in a single month as a result of COVID-19 and the SMEs being closed. Largely, entirely. If you didn't have an online business, essentially you were closed for the better part of 3, 4, 5 months, and you didn't really get started properly again, and some of those businesses never just opened. This is depression level, which unfortunately data-wise we don't have, and it's one thing I aspire to do to get even further level, but we have never traded that high. Now, the bigger the bear, which the high level mark of the gold silver ratio illustrates, even though gold stayed at 1,050, because now people have seen this printing game is coming. Gold never went back to 268. Silver went a long way back, and actually in the COVID-19 traded its lower level, just sub $12 at about 11.75. So what you actually had is the most extreme gold silver ratio ever. Now the harder you smash up out the top, the faster and further you go to the downside. I'll say that again. Very typical of overbought or oversold markets, and those phrases mean nothing. I hate using them. But hyper overvaluations or hyper undervaluations, the more extended they go, the far more brutal the backlash moves. So in fact, you inject volatility and wild swings when you create great imbalances. It's like pushing the big beach ball really deep underwater. The harder and further and the bigger the beach ball, the more the air will correct in it. And this is like a nitrogen beach ball because I pushed it to 126.1. Further to which, we will illustrate here that this period in 4 months from that selling, and we called at 113 the reversal and said, you now need to move out of the God market gold, overweight into silver at 113 on technical analysis done on a far smaller time frame than the monthly chart, that we said this is likely to be the first reversal. This is a major overshoot. We're the best and only people that seem to be doing detailed technical analysis on the relative valuation and everything it tells you. And you have 4 months, that red candle, that little green, and these two reds. There is not a period from 1976. So you're going to go within a couple of years when I was just a wee man wearing 5-year-old boys' clothes, which never included underpants because I was in Africa and it was hot. A very limited wardrobe. Way back then, when there isn't a single 4-month period where you've covered that adjustment in relative valuation. I blame my mum for that, by the way. 115 to 72. In 4 months? In 4 months, you've corrected 115 to 72. Here's 4 candles. 1, 2, 3, 4. It's not nearly the same. Here's 1, 2, 3, 4. Not nearly the same. Choose the green 1, 2, 3, 4. Not nearly the same. That's 2 sets of 4, 8 candles. It's not met what we've done in 4 months. And it absolutely endorses what I say, that the turn will be bigger, harder, faster, and more violent. So to the question that was asked by the Twitter man, that took 20 years for that bull market. I'm saying it was a truncated bull with many competing asset bubbles that were inflated and deflated, including .com and tech stocks and property in between, that distracted the money that should have flowed into real money. It distracted the currency that should have flown into real money. And it only actually got let off its leash for a short run and then got stamped on with government policies, etc., that took over, and the recovery narrative and all of this. So the prediction I'm making is that at bare minimum, we meet this, but actually I'm expecting us to trade below double digits. In other words, single digit gold-silver ratio. Hear me now. Single digit gold-silver ratio. That will certainly surpass the relative valuation over there. And I expect match or surpass the 80s boom, which did not go as high by some degree. And I suspect that we will go as low. Now, there's a lot of problems that come with this amazingly good news, and we'll touch on that later, that the likes, as I say, of the people who are selling gold and silver. I like to mention Peter Schiff. He's actually broadly accurate on the gold bull market. He said his camp on being antagonistic to crypto. I don't think that's the smartest move. Mike Maloney didn't do that. But anyway, without getting into the personalities and commenting on that, a lot of good stuff comes out of there from them. What I want to highlight is the lower part of this. I put historical volatility. Historical volatility met 150 in the 80s. That was Nixon, as a result of Nixon disconnecting the dollar. So every currency had a gold standard, then every currency connected to the dollar and floated against the dollar, and then the dollar released itself from being the gold standard because it had the highest amount of gold at one point after Nixon was carpet bombing Vietnam and printing dollars to fund a war machine under the guidance of Kissinger, Dulles, and all the criminals. And bad money and just communism versus capitalism, well, nonsense. You got 150. What scale of volatility after a global pandemic shutdown that has closed many SMEs and the ongoing threats of second waves, the Bolshevik communism that is coming, the UBI Another question. Let me just sidebar right here. Another question that came in that I really need to deal with. UBI. It depends how much, says this question. It depends how much they will print. How far the gold will go will depend on how much they print. Just want to find the question. I'm sorry, being a bit ham-handed here. Let's go back here. So much that I wanted to check. So essentially he was asking, and I'm just going to paraphrase, it depends how much they're going to print. My answer was perpetuity. The game has changed. UBI is already 1 foot in the door. What do you think furloughed salaries is? It's paying people to sit at home. They've got the first payment through. They are completing their agenda. Now a big pause. We're waiting for America's next commitment to stimulus. Everybody. It's expected and it will come. So then there'll be new $600 a week, new whatever's. The rest has expired. But they need to leave a little pause to make you beg for it so that you don't actually notice that you are being slowly manipulated into a universal basic income for people not working. Why can't you see that? And how, when people do that, when a government is slow loading you into a game that they are always set to play as Bolshevik communists that want you as dependents. They want the bulk of the population as utter dependents. Therefore, they can tell you what to do to collect your welfare money. And there will be a universal basic income. This agenda was launched because they need your dependency. It entrenches state and it gives them almost God-like power because now they pay everyone and therefore you must comply. Otherwise, your social score's gone down and therefore you only get X% of your UBI, and that is the control absolute. It's a very short hop to complete totalitarianism. People think the journey is long. It creeps up on you by those that are doing it, and you are a very short hop away from it, guys. You've got to understand this. You've got to understand that UBI is here. It isn't an idea. It's here. It's happening already in part, just not monthly, weekly, officially. By the time you realize it's in perpetuity, it's going to be in 18 months. It's always going to sound like a temporary measure, just like a temporary goddamn tax. These people are professional deception liars. You need to understand this. UBI is here. It's here. Not in name, but it's here. Government paying wages because industries have shut down. It's here. What don't you understand? Because it's not got a branding that you're expecting yet. It's here. Okay. So the volatility, 150 during the 80s bull. I've topped and tailed the 100 level. Let's just get the pen. The 100 level, the 57.5 and the 15 level. You overshot on the low end before you had your super volatility on the high end. It is typical. It is typical that you have extreme low volatility just before you have an exceptional high volatility event. You do not know anyone who studies gold who understands like volatility that in the way I do, and will have it and recognize it. The volatility is your power. The low volatility to high volatility expansions is the best breakout trading. It is what HVF, Hunt Volatility Funnel Method, is based on. It's quite clear. It's the key word in that name. So low, you had one other dot of lowness. The rest touched or were above. We recently in 2018 had the one other event of extreme low volatility. If you weren't already stacking then, you were missing your best stacking period. And we are just beginning a leg up. And let me tell you, this staircase up, 1, 2, sideways, 2, sideways, and then you freaking moon on volatility. This is already stronger than that first up leg. How far does he go? In transgender, pink, I ask you because it matters more, the question. And you have to answer potentially a lot further. And the volatility will surpass what was a not even full bull run. I mean, you had similar volatility runs here. You didn't get through 100. And if you think we can't surpass the 80s bull market, which was Nixon destroying the dollar and the French and many other European nations and asking for the gold at the fixed rate back rather than their paper that they were printing, you don't think globally synchronized. That was a Western affair. That was America and Europe. That was between them. Now we're talking globally synchronized. All of Asia, Australia, Africa, Latin America, COVID-19, shutdowns, huge FX emerging failings. They're all going to go into fail against the dollar in time. You think the dollar's weak now, it is, but they will go into fail soon. They're all getting free swap lines, loans that they all should be paying back. Nobody is selling stuff to Americans to earn the dollars to be able to pay it back. Their currencies will fail, and then there'll be wholesale debt jubilees. This is on a scale never seen economically before. It's why I built a business with the reset sniper in it. This is a reset. This is economic history, never in a global context. How high does that volatility go? And how far does that XAG ratio to XAU spill? You could get 4 silver ounces to buy a gold. You could get 3. You might get 1.5. I don't know. But I'm saying my bias, and I'm sticking my neck out, the guy who called single digit oil when it was trading at 60, you never bought oil for $1 in most of your people's watching's life for $9.99. Nobody. Not even in Qatar 10 years ago, 20 years ago. So I'm saying to you again, gold-silver ratio, single digits. That's what I'm saying. Now, I've got more for you because this is a detailed YouTube. This is a detailed YouTube for people that really want to understand what's going on and the scale of what's happening here. It's economic history. So, here's what I've gone and done. Now, if you go to the gold chart on TradingView, I actually want gold futures. So generally, if you can, for proper history, use the gold futures. Now all my symbols are a little bit moved down, so forgive me for that. There we go. We're also looking at Tezos there, as you can see. So, okay, you've had a little bit of slap in the face now. Let's have a look at the gold futures. Now what you need to do is this. So you're learning a lot here, and I've been taught and shown by others, so I'm going to share it with you. And I would appreciate a like and a share because I want to help you get better at what you do. We do this 100% of the time in our community. And now some of that leaks out to Freeview to help get you guys along because this is big and it's important. So click on the economy here. Otherwise you won't find it. Yes. Then you've got to type CPI AUCSL, Consumer Price Index for all urban communities. Now this is coming from who? The Bureau of Labor and Statistics. BLS, Bureau of Labor and Statistics. Now if you look at this chart and you deflate it for inflation, gold hasn't made a new high. You'll see the values are lower here. Gold hasn't made a new high. In fact, you have a huge cup and saucer stroke ascending HVF in a new trend. That's on the government deception dark states statistics. That's what you're getting. So for those of you that say you're late, I'm saying you're not late. You don't know how far this is going. The trains only started moving. It's like a 60 carriage train. Many people can jump on The doors are still open, but it has started moving on the platform. But actually, some carriages are still moving in the platform area. You can run alongside and jump on. And it's going Trans-Siberia, Moscow to Vladivostok. So the couple of meters you have to run down that platform is the percentage you're late for getting to Vladivostok. You're getting 99.99 pure grade gold and silver percentage of that journey.